Hi, I'm Rudy Luco with Morningstar.ca. Joining us today to talk about trends in the fund industry and his own new venture is Som Seif. He's the founder and CEO of Purpose Investments. Purpose, in September, launched its first funds, which come in both mutual fund and ETF versions. Som, there are now thousands of mutual funds and several hundred ETFs in Canada. What is it that Purpose brings to the party?
Yeah, well, thanks, Rudy, for having us here. And so there's a few things I'd say. One, look, no one needs another investment management company in this country. And in fact, there are thousands of investment funds. But what we're doing is pretty impactful. And when I say that is, our goal is to change the industry. And this idea that you need to charge lots of fees to get good quality investment management. And it's very important when I say this concept of good quality. So, I believe that fees matter. That fees ultimately are one of the key determinants of good long-term net results on an investment fund. But at the same time, it's not just about fees. It's not just about giving you the lowest cost. It's about giving you the lowest cost relative to the value. And so what we're focused on is not just low fees, but also high quality. And quality is an important concept around the investment discipline, the strategies that you use, the rules that you're using to actually invest. But then on top of that is the risk management. And this is the missing piece that I believe this industry faces, is that a lot of players today are just giving you market return betas. They're going up and down with the markets. And our focus is that what really matters for clients is how do you protect clients from risk? How do you manage risk? How do you bring high quality investments, but also reduce drawdowns, help investors compound the returns better? And today, a lot of that thinking is actually in what we call the alternative space, the hedge funds community. And we think that there's some really important principles there, but most of them charge way too much for their trade, just like long-only money managers do. And our view is to bring that to the broader market and really bring risk-managed, high-quality, deep investment philosophy with low fees, which is just unheard of in this country. And that's really what Purpose is about. And we're changing the industry as a result of it.
You've partnered up with Breton Hill. Tell me about that firm.
Yeah, well, look, Breton Hill is probably, it's a firm that many people don't know about in this country, and it's because they're really focused on the big institution, the pension plan. But they're a global macro alternative shop based in Toronto. But they actually run money for, they were seeded and run money for CalPERS, the largest pension plan in the United States.
In California.
In California,
yes.
That's right. And what they ultimately do is they run money on a global macro basis across equities, bonds, currencies, commodities. And their focus is on risk management and on really focusing on asset class diversification and risk diversification. Well, I approached them because I said, look, you guys are fantastic at what you do. I need to use this intellectual capital that you guys have, and I want access to it. But you're focused on the big institution, we're focused on everybody else, and we want to bring this to the broader market. And we structured a really great relationship, and I was able to negotiate such that they own an equity stake in Purpose, and as a result, we're able to keep our costs really low and deliver this phenomenal intellectual capital to the masses, to every investor, whether you're a small investor, an investment advisor and their clients, as well as a high net worth and family office small institution. And that's really our target market, and it's been very powerful.
Now, there are actively managed funds, there are market cap index funds, and then there are, I think this is a hybrid somewhere in between, a rules-based. And what are some of the key rules, and do they tend to stick with those rules, or do they deviate much, change the rules?
Well, Rudy, it's very important. I mean, so I built my career, as you know, with Claymore. I started that firm and sold it really based on a very simple principle, which is that you can be thoughtful around your investment discipline. You don't need to be just benchmarks. And so when we talk about, call it the active passive, what we care about is, what makes passive really work is it's got its low fees, but it also has an unemotional approach to it. And what I've always believed in is you can take the thoughtfulness of what really good active money managers do really well, the factors that they use to select and weight securities, the way that they do asset allocation, all the rest of it, and you can systematize it, you can quantify that. And if you can take that down to a set of rules, you can capture 80% of what great active money managers do, but by reducing the fee, you can outperform the majority of the market. And we've proven that in the past with Claymore, and now what we're doing with Purpose is even going deeper. So we are passive. We don't have somebody picking one stock over another stock, but we use a bottoms-up fundamental approach to everything, and it's based on a set of rules and factors. So example, in our dividend screens, dividend fund, we use quality and historical dividend consistency and growth as our core focus, and the factors that we use on quality is something that's very powerful. It looks at the fundamental health of a company, the trends and the business, and what is the business doing right, and is it in a position not only to have historically done something right, but to continue to do something in the future. And that really adds a ton of value in screening for good quality companies, and then companies that are going to perform, not only giving you good income and distribution, but also good capital appreciation.
Mm-hmm. As you know, with any new startup, it takes time to build a track record, and Morningstar analysts generally look for at least 3 years. And how do you respond to that when people make the comment that this firm, this money manager, Breton Hill, was just formed in 2010, doesn't have a very long track record?
Well, it's all about intuitive decisions and transparency. So I believe that when someone understands what you do and it's intuitive to them, then ultimately that's really what the principles are. Everything we do is fact-based. Everything we do is based on a set of rules that make sense, and that ultimately when I ask people, how do you think about investment management? And when they look at this and they say, this is the way I think about it, this is the way I wish every money manager was disciplined. And so it's about those disciplines that are very important. It's about those rules. It's intuitive. The second thing is, look, it takes time to build a track record. It's very important. But as long as you're doing things based on, I believe in reversion to the mean. I believe that what works in history ultimately will generally work in the future. And I believe that the key is having the right fundamentals to how you actually invest. And if you do that, and you prove that, I did it in the past with Claymore. I built a Claymore based on a set of principles, intuitive thinking, and our products are some of the top 2 quartiles funds in this country, and they proved it over years. And Purpose is just going deeper and better. And that's really it. Now, the question of Breton Hill, this is a very important point. So Breton Hill as an organization has actually been around together as a team for over a decade. And the research that is behind everything they've done is actually over 20 years of research. Breton Hill is a standalone. They started a firm historically, very successful diversified global asset management firm called DGAM, which is a firm, very successful alternative shop here in Canada, back in 2004. And the team just decided, look, we wanted to run our own shop, so they ended up breaking off in 2010, and they got seeded by CalPERS, which, respectfully, CalPERS is, a very, very strong player, and to do due diligence, this is the first firm in history that CalPERS has ever seeded publicly, and this is a big deal. And they even press released it was such a big deal, let alone a Canadian firm. So, we think we've got a great partner, and, the one thing I would say is that just 2 months ago in July, they were ranked as the #1 Canadian overall hedge fund in the world by Hedge Fund Review, which is the major publication for hedge funds in the globe. So we're very proud to have a partnership with them, and we're excited about what we're bringing to the marketplace. And I think that's what it comes down to, the fundamental rules and the factors that we ultimately are bringing all the products based on.
Okay, let's talk about fees. You said fees are important, but at the same time, fees aren't everything. So tell us about your positioning vis-a-vis fees. You're not channeling Vanguard here with this firm with the absolute lowest.
No, I don't believe that fees, 10 basis points for a benchmark index is quality. I actually think benchmark investing is a very bad investment strategy when you think of it. And the problem, Rudy, is that if you look at why people are buying benchmarks, it's because they can't find good active money managers that are worth their trade for their fee. That's it. And to me, it's great. I think indexing and the cost of benchmarking for traders, for people who want to get beta exposure, tactically, all that stuff is great. And that's what Vanguard and iShares and players like that are really competing on. We're not focused on that. I've never been focused on it because I don't believe, my products are built for investors, for people who want to invest long term. And when it comes to that, you better have really good fundamental thinking behind the way you select a security, the way you own an asset, and the way you apply risk management. So what we're doing around fees, so our fees range from anywhere from 45 basis points for our bond fund to 55 basis points for our dividend fund, up to 80 basis points, and that sounds high, but 80 basis points for our alternative hedge strategy. That's the same comparable to a Picton Mahoney or other long-short managers who are charging 2 and 20. So 80 basis points versus 2 and 20, that's where we're competitive. And we look at the spectrum of the industry, and our goal is not just to be 10 basis point betas. Our goal is to give you the best outcome for the lowest price point. It's about value for the cheapest fees. So we'll never compete on fees. We're going to compete, what I mean by that is on the lowest price. We think fees matter, but the way you invest your strategy matters more.
Yeah, and just to clarify, those fees that you quoted, those are the ETF fees, and those do not include the advisor compensation, which is in line with industry standards.
Yeah, so we believe, so we have a management fee on our ETF that is accessible by every investor and advisor, our F series, which is available for every investor and advisor on FundServe, and then our advisor A series, which has a trailer embedded on all the products as well, which is, so the fees, we're agnostic to how someone uses us because we charge the exact same management fee across all of our units, or all of our series. But what we care about is, them using it to fit their book of business. It's actually one of the big novel things that we've done, Rudy. I think you made a comment about it. We believe that ETFs and mutual funds have gotten this, competitive thing about them, and I think that's wrong. ETFs are a mutual fund that just happens to trade on an exchange, and a mutual fund is on FundServe. So what we cared about was bringing a product that is accessible by an advisor the way they want to access it. So if they want to use us with their fee-based accounts, they can use our ETF or our FundServe. If they want to use us with their trailer fee accounts, they can use us with their Series A. But it's about their business and our product fitting into what they do, not about us telling them that an ETF fits here and a mutual fund fits there.
Mm-hmm. And we should also note that your funds come in a corporate class structure, so that you can switch from one to the other without triggering an immediate capital gains event. That said, you got your first 5 funds launched in September, and that's not a lot of choices to do switching on, but I gather there's more on the way. What's next for Purpose?
Well, we got a lot of things we're building. I mean, we've our goal is to bring really high quality product. We're not going to be everything to everybody, so that's one of the key disciplines. You'll never see us having 50 or 60 investment funds in the marketplace, but we're going to bring quality. And so, we want to build products that are ultimately going to be in both the traditional space, the long only, the alternative space, so things that are going to be much more focused on risk management and hedging out market risks, and then on the absolute return portfolio side. So we believe that absolute returns are the way clients really think, and our portfolios are going to be designed around absolute returns. So you're going to see a continuation of that kind of growth, so around portfolio solutions, alternative solutions, and then traditional long-only solutions. And we think we've got a great set of investment funds with our first 5 that allow a client to build a really well-diversified portfolio. And then outside of that, things that we're looking at, so we are launching a high-interest savings cash ETF that will be not in the corp, but it'll be outside of the corp. We're launching a short-duration global bond ETF, very attractive global bond with short-duration tilt. And then a short-duration emerging market bond ETF that, again, will allow an investor to get exposure to a global emerging market currencies and bond and interest rates, but without having to take the interest rate duration risk of those.
Okay. Som, thanks very much for this, and thank you for watching.